If you've been watching currencies, precious metals, energy markets, or simply listening to how governments speak when pressure rises, you can probably sense it. The tone is changing. And when tone changes, behavior usually follows. Here's the core idea up front. We're entering a period where stress in the system stops hiding, where cracks don't stay theoretical, where confidence starts to wobble in ways markets can't smooth over forever. Yes, this connects to gold and silver. Yes, this connects to geopolitics. And yes, this connects to why markets often look calm right before they become unstable. Before we go further, quick note. If this kind of thinking helps you see the bigger picture, hit subscribe. A lot of people watch and learn, but never support the work. That one click makes a real difference. Now let's break this down. The global environment right now is loud, emotional, and polarized. Certain regions dominate the headlines, and the framing is almost always the same: urgency, morality, and a demand for immediate action. But there's a pattern here that keeps repeating. Complex situations get simplified. Public emotion gets pushed hard. Questioning the approach feels uncomfortable. And when consequences show up later, they're treated as surprises instead of outcomes. Energy prices react. Supply chains tighten. Governments spend aggressively. And currency creation accelerates to fund emergency responses. This isn't about good intentions or bad intentions. It's about incentives and results. When pressure builds on nations over long periods of sanctions, humiliation, and external control, reactions don't stay moderate. They harden. Nationalism rises. Distrust becomes policy. That's not ideology, it's human behavior. What makes the current moment more dangerous is how the conversation is framed. You're often presented with only two choices: ignore the situation or escalate it. That's a false choice. And false choices push people toward outcomes they might not support if they had more room to think. Zoom out further, because geopolitics doesn't stay in its lane. Conflict isn't just political, it's financial. When instability increases, energy markets don't need actual shortages to spike. Risk alone is enough. Insurance costs rise. Shipping routes change. Speculation accelerates. Panic hedging kicks in. And energy feeds everything: transportation, food, manufacturing, inflation expectations, interest rates, daily living costs. Oil is still the bloodstream of the global economy. When that bloodstream is threatened, the entire system reacts. That's why gold and silver matter in moments like this, not because people are excited, but because they're uncertain. Precious metals don't surge when the world feels confident. They move when trust in systems starts to weaken. And while attention stays locked on one crisis, other moves happen quietly in the background. Actions framed as legal, moral, or technical often reveal their true motivation when you follow the incentives: resources, leverage, and control. Energy-rich regions aren't just political talking points. They're strategic pressure points. Control energy, and you influence trade, currencies, and global bargaining power. Then there's the third layer that many people dismiss too quickly: geography and positioning. Certain locations sound irrelevant until you realize how much future trade, security, and resources flow through them. What's changing right now is not just policy. It's unpredictability itself. When leadership signals that rules are flexible and restraint is optional, the world doesn't respond with trust. It responds by hedging. And when the world hedges, behavior changes. Reserves get diversified, trade patterns shift, risk gets repriced, and assets that don't rely on promises become more attractive. This is where gold and silver re-enter the picture in a serious way. This isn't just fear, it's a shift in confidence. Confidence in currencies, confidence in leadership, confidence that tomorrow will look like today. And here's the uncomfortable truth: the global economy is not uniformly strong. Debt levels are high, consumers are stretched, governments are boxed in. That makes shocks more dangerous and reactions more extreme. When stress increases, leaders tend to reach for familiar tools, more spending, easier money, bigger deficits. These tools can calm markets temporarily, but they often weaken purchasing power over time. That's the trade-off. Stability now, pressure later. Silver adds another dimension that people underestimate. Gold is mostly stored. Silver is consumed. It's embedded in technology, energy systems, medical applications, and infrastructure. Once silver is used, much of it is gone. So when investment demand and industrial demand rise at the same time, price doesn't move smoothly. It jumps. There's also a psychological factor. Silver still feels accessible. It doesn't feel reserved only for institutions. That accessibility can turn steady interest into sudden momentum. Now, let's make this practical. This isn't about predicting exact events or dates. It's about understanding direction and incentives. When savers feel punished, they look for alternatives. When trust weakens, people hedge. When enough people hedge at once, prices move. Nothing moves in a straight line forever. Pullbacks happen. Volatility shakes people out. That's normal. But structural shifts don't reverse easily once behavior changes. The key difference is time horizon. Thinking in weeks is speculation. Thinking in years is positioning. The goal isn't to be perfect. The goal is to avoid being overexposed to fragile promises if the rules shift. So ask yourself a simple question. In a world that feels more volatile, more divided, and more unpredictable, what actually holds value without needing permission? If this helped you think more clearly, subscribe. Drop your thoughts in the comments. Do you think hard assets will outperform paper assets in the years ahead? Or do you see this as temporary noise